The US really did go ahead with this border adjustment tax, and if it was applied to services as well as manufactured goods, that would be a big negative for these outsourcing models. But the fact is, we don't know if they're going to go ahead with it or not. So it remains uncertain. But all this risk makes me want to concentrate portfolios in Asia and emerging markets, still primarily on domestic demand stories. And my long-held view remains that India is the best domestic demand story. So I'm retaining a big weighting in domestic demand stocks in India, but I'm not weighted in the IT, the pharmacy areas. I'm not betting on those areas, nor am I betting on the capex geared areas in India. I'm betting on the domestic. I'm basically owning the domestic demand areas. And in my view, those domestic demand areas are less impacted from this potential threat to globalization. But it needs to be stressed that if the Trump administration doesn't go ahead with this border adjustment tax, and if it's just a question of tax cuts and corporate tax amnesties to try and get the $2.5 trillion of US corporate cash estimated outside of America back into America, that is not a big threat to globalization. So the devil's in the detail in terms of the policies announced. As of today, it remains unclear.
Chris, how much of the current appreciation in global equities is a pure function of change in allocation? The bull market in bond market is clearly getting over, which is forcing money managers to move out of fixed income and move back to equities.
Well, there's an element of that going on. You're absolutely right. There's a growing consensus that the bull market in government bonds and US Treasury bonds, which has been going on for 35 years, the bull market in US Treasury bonds began in 1981. More and more people think that is over. However, it needs to be stressed that there's no technical evidence that the bull market in bonds is over. If you draw a trend line from the beginning of the US Treasury bond bull market on the 10-year yield, the top of the trend line is just above 3%. Today, when I last checked, the 10-year yield was 2.4%. So to have technical evidence that the bull market is over, you need a convincing break of that 3% level. And that evidence is not in. So I think it's premature, personally, to conclude that the bull market in bonds, Treasury bonds, is over. Part of that will depend precisely on the policies implemented by the Trump administration.
Chris, you've always liked India, and as per your latest model portfolio, India is an overweight position. Is it likely to remain this way, or are you now worried about run-up in Indian stocks and valuations are looking stretched?
No, well, the valuations, basically, my long-only Asia ex-Japan portfolio has about 25 stocks. I'm more than 50% in Indian domestic demand names in that portfolio. Frankly, I own the sort of stocks that were hit most directly by demonetization. But the good news for my portfolio is these stocks have rebounded strongly in recent weeks, months since demonetization. Tactically, there's probably a case to take some profits in some of these domestic names because they've had good runs. But as it's a long-term portfolio, I'm not going to do big profit taking because I still think India is the best domestic demand long-term story. So I'm continuing to focus in areas like financial areas. I'm hoping and expecting that demonetization will be a positive for the long-term promotion of use of financial assets in India. And I'm taking the view that, demonetization initiative is a positive, not a negative.
Chris, you've raised concerns in the past about the fact that Indian investment cycle or the capex cycle is yet to pick up. And unfortunately, that is a statement of fact. The investment cycle is yet to pick up. So are you a bit worried about inward-looking sectors, domestic-looking sectors, which still rely on the pickup in capex cycle?
Yeah, no, I'm not expecting a pickup in the capex cycle in the new fiscal year approaching in India. And I haven't got capex geared names in my portfolio, and I wouldn't be overweight them. The only good news is that no one else is now expecting a pickup in capex in India in the new financial year. so new fiscal year. So if there is a pickup in capex, it will come as a pleasant surprise to me and the markets. The key reason why I think the capex recovery is being delayed is the overhang of stressed loans in the banking system. And while the banks are gradually owning up to more problems, we have not seen under this India government a proactive recapitalization of the problem banks. So that will continue to mean that these problems will be addressed in a very slow way, which means the overhang continues, which means the investment cycle will be delayed. But the positive side for this is that the distressed nature of 70% of the banking system means that the private sector banks, the highly rated private sector banks, have a huge opportunity to continue to increase their market share. And the demonetization, the electronic ID card is clearly creates the potential for promotion of digital banking. So I'm not in the capex orientated area.
Chris, I noticed that finally you have a buy or preference towards Bank of Baroda, which happens to be a PSU bank. In the past, you've raised concerns about Indian PSU banks and their opaque book quality. Are you getting convinced that at least the 2-3 large PSU banks, they've done their bit and they're available cheap?
Well, one's hoping that, I think it's clear they're getting more proactive about recognizing problem loans. So that's the good news. I suppose the risk is they may be forced to merge with more distressed franchises. So I wouldn't want to have my whole banking position in PSU banks. I think you can own one, my core focus remains the private sector banks.
Do you think the challenges which Indian IT companies are facing, are they real, or it is time to be a contra buy in Indian IT companies?
No, I think from a relative valuation sense, they're looking probably attractive, but personally, from a long-term basis, they're not my core theme in owning India. Also, we need to see what the US administration is going to announce or not announce on this whole issue of potential protectionist actions, potential attacks on outsourcing. Hopefully none of this happens, but we can't be sure.
Chris, the fact that Indian IT companies are now considering a buyback, some of them have announced a buyback, some of them are about to announce a buyback. Is that tempting enough for you to relook at them? Because if they do a buyback successfully, the return ratios would increase significantly.
No, that's all. In an Indian dedicated portfolio, clearly you would own some of these companies on a relative valuation basis. But my portfolio, I've only got 25 stocks in Asia, so that's not my core area of focus.
You've always liked Indian HFCs, names like HDFC Limited, Graha Finance, India Bull Housing Finance. Do you think the current government's focus on low-cost housing and housing will ensure that the growth highway for HFCs in India will remain strong?
Well, I'm assuming housing finance is a core area of growth in India. The budget came up with the expected news of trying to promote the housing market, especially the lower cost housing area. Clearly, a demonetization approach has negative implications for the real estate sector. You've also got very important regulation being introduced to the real estate sector, which in my view is merited and long overdue. That's going to lead to dramatic consolidation in the property sector. You're going to get many developers going out of business because of the much tougher requirements on putting pre-sales of developments into escrow. But I view the housing finance companies as a core long-term hold, and I think the best quality property developers will be the winners from the dramatic consolidations that's going to hit the real estate market as a result of the combination of demonetization and the introduction of long overdue regulation in the real estate market and the related attack on so-called black money.
So, Chris, if I insist that you have to choose between Indian private banks or HFCs, which way would you lean?
No, I probably lean to the former.
Any specific reason?
Well, only because if you're only in one or the other, then it's one is a more pure macro play, right? But I think it's a close call. I don't have an extreme view of that. which is why I own both areas in my long-only Asia ex-Japan portfolio. I should add, by the way, that I've started this portfolio as long ago as October 2002, so I've basically always had private sector banks in India in this portfolio.
And I must compliment you on your choice of stocks here, Chris. I've been tracking this portfolio for nearly a decade now, and you've really identified some of the big winners and mega trends right ahead of the curve, whether it's Indian real estate names or names like Titan. Chris, any specific reason that you are giving consumer staples still a pass?
Well, again, I think right now they're out of fashion because the fashion amongst global investors is to buy cheap cyclical names and avoid expensive growth. There's got to be a concern in terms of the rural-orientated staples that you'll see. You haven't seen the full impact of demonetization yet. But to me, they're not, they're just not the most interesting. They're a perfectly good story, and I've owned such names in the past. It's not because I'm hugely negative. But I think in the short term, I think one wants to it's probably premature to assume that you've seen all the impact of the demonetization on these areas, particularly rural consumer staples.
Chris, any specific reason why property stocks have been a constant part of your portfolio? When you say you have only 25 stocks in your portfolio, you're being highly selective here. And Indian real estate companies in the past, they've had some issues, but yet you continue to prefer and like Indian real estate stocks. That's been a constant feature of this portfolio.
Yeah, well, the Indian real estate sector has got a very low market capitalization relative to its potential compared to, say, the Chinese real estate sector, Hong Kong real estate sector, Japanese real estate sector. So there's huge long-term growth potential, but it's been a bit of a morality tale, the Indian real estate property sector, where the right approach, and initially the right approach was to buy the high beta names when this whole real estate cycle first kicked in 10 years ago or more. But I think right now the key issue, the long-term issue, is to concentrate portfolios in those developers whom you view will be able to deal with this dramatic change in the business model, where, so far as I understand it, the new rules will say that if you're a developer launching a project, you have to put 90% of the pre-sales revenue into escrow. So to my mind, that's going to be a very tough hurdle requirement, and only certain property developers will be able to do that. And I think the developers who've got a track record for completing projects in the past and have got the balance sheet to deal with those new tough rules are going to be long-term winners. So it's going to be a long-term story, but I think it's a long-term story that will work.
Because you've always liked Indian banks which have retail franchise, whether it's HDFC Bank or IndusInd Bank. Will it remain this way, or now you're bent towards banks which are corporate in nature, which have a wholesale balance sheet, which will be lending to corporate India? Are you tilted that way?
No, I'm tilted to the household deposit-driven banks, and the hope is they continue to take market share of the public sector banks. Well, not the hope, the expectation is they will continue to take market share of the public sector banks, and the other expectation is advances in technology. The dramatic take-up rate of the ID card will allow for them to move it more proactively into digital banking, particularly in rural, less developed areas.
But do you think the challenge for something like HDFC Bank could be that A, it's expensive, and B, the FI limit is frozen, so new buyers cannot enter till the time old buyers they check out, old buyers they sell?
Well, that's been the same story for 10 years or more, right? I've had this stock in my portfolio for a long time, so if you're a new buyer today, that's obviously an issue.
Chris Wood rarely speaks on media, but when he speaks, he's expected to talk about a big prediction or a mega trend. So if you have to isolate one big prediction for 2017 and beyond, and if you have to identify a mega trend, local or global, when I say local for India or global for world economy, which are the trends you would like to identify?
Well, no, I mean, well, there is a question mark on globalization, but I say only a question mark because we don't know the detail of the policies, so we don't want to get too alarmist as yet, but there's clearly that risk. In terms of emerging markets, I think a positive, important point to note is that I've gone overweight China in the last few months and raised my weighting in China in December, raised my nature overweight, and the key reason for that is that the PPI went positive in China in the last 2 quarters. PPI has been negative in China since early 2012. And the key reason I increased my weighting in December, because I went to Beijing in December and I became more hopeful that supply side discipline, supply side reform will continue in China, because we saw production cuts in steel and coal in China last year. My base case is that supply side discipline continues, and that's a big positive for anybody involved in those sectors such as steel, coal, etc. globally. And if the upstream sectors in China continue to improve because of this supply side reform, it means that the reported asset quality in the Chinese banking system will improve too. Yeah, so I'm now overweight Chinese shares in Hong Kong, in so-called H shares, but it also leaves a better backdrop for the whole industrial metal complex globally. But my story does hinge on the supply discipline continuing in China. And that creates a more positive outlook for the emerging market asset class as a whole. So emerging markets are outperforming year to date, both in bonds and equities. That is not what the consensus was expecting at the start of this year, but that's what I'm expecting to continue.
Chris, you mentioned in your reports and in your notes that you expect the oil producers to maintain some degree of discipline, yet you're not very optimistic on crude. Why is that? If the supply is going to be controlled and if global demand is making a comeback, don't you think crude prices will move higher?
Well, in the short term, crude supported by the key thing, the other thing helping emerging markets in the last several months is Saudi Arabia did a total U-turn on its policy towards oil. It went from flooding the market to try and undermine shale to renewed production discipline. And the Saudi strategy, in my view, is to try and keep oil above $50 in the run-up to them listing their oil company. But the long-term risk to oil is precisely because they're keeping oil up in the $50 to $60 range. That will mean that shale production in America will come roaring back. So there's going to be a dramatic increase in supply in the US, and that means that long-term oil is going down again. But oil, Saudi will definitely be determined to keep oil above $50 before they do their IPO. So the oil price is probably stable until they do the IPO. So the key point is you want to know when they're going to do the IPO, and you want to sell oil the day they do it.
Chris, in the past you've indicated to your readers and to our viewers that gold should be a must-own part of key portfolios. Would you like to maintain that view?
No, I maintain that view for global investors. I think in India's case, it's rather different. In India's case, there's a tradition of holding gold. The Indian government under Prime Minister Modi is trying to promote very sensibly the use of financial assets. So in India, if this policy is successful of demonetization promoting financial assets, I can see demand for gold declining on a secular basis. I can see a generational change to the attitude to gold. So so I don't think the Indian situation is particularly bullish for gold, but I'm talking from a global perspective. A global perspective, I think you need to maintain a position in gold because you've had extreme monetary policy practice in the developed world in recent years. You've also had a further huge increase in G7 government debt to GDP ratio. So just to take the example of America, the formal government debt to GDP ratio in America is 104%. It was only 30% when Ronald Reagan entered the White House in 1980. And if you add Fannie and Freddie alone to the government debt GDP, most people would assume that Fannie and Freddie debt is in reality US government debt, that adds another 30 percentage points and more to total government debt to GDP. So with these extreme monetary and fiscal easing, I believe you have to own gold. Also, gold ultimately will win either way. Either Donald Trump's reflationary protectionist policies will work, in the sense that they get traction cyclically, in which case inflation will pick up in America, or they don't work, in which case you get a reality check and you're going to get more unconventional monetary policy in America.
Chris, I know we've extended our appointment with you, so I'll restrict it to just two more questions. When it comes to Indian equity markets, Chris, do you think a long-term, sustainable and a secular bull market has started in India, or Indian markets from these levels at max would give 8-9% compounded returns?
Well, the long-term, for the long-term secular market story to be valid, we will need at some point an investment cycle. But for me, my base case is we are in that long-term secular bull market, but my base case is we don't get the investment cycle in the next fiscal year, though I would love to be proved wrong.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.